Welcome to today's episode. How do you build an investment portfolio? If you're a beginner and you've been thinking about investment, like where do you start? So, if you ever ask yourself, how can I even start building an investment portfolio? I made this video for you, and I will walk you through a step by step process on how you can build an investment portfolio specifically for beginners. uh, and I will use practical examples just to help you understand how you go about it. These are 10 minutes video, so this is what we shall look at. What is an investment portfolio? Why do you need one? How do you design one? How do you balance risk versus reward? And then finally, how do you monitor, adjust, and keep working on it so that it serves you well? So let us begin by looking at what is an investment portfolio. Think of a portfolio like a garden. When you have a garden, you don't only plant maize, you plant a collection of plants or crops. You can plant maize, you can plant beans, you can plant vegetables or any other things in the same plot of land. That way, you do that so that if one crop fails, others will survive and feed you. And so it's the same analogy that when you use when you are talking about an investment portfolio. So it's the same idea. So an investment portfolio is basically a collection of different assets. Think about stocks, bonds, real estate, funds, different kinds of funds that work together. Some of these will grow fast, some of these are stable, some of these will give you returning income, so that at the end of the day, any element in that particular portfolio keeps serving you for a long period of time. What options do we have in Kenya? So in Kenya, your portfolio might include Nairobi Securities Exchange, government bonds, government bills, money market funds, real estate, SACCOs, mutual funds, and many other special funds and many other. The goal is simple: not to put all your eggs in one basket. Now let's start to look at why do you need one? Why do you need an investment portfolio? Reason number one, just like the farm, like the garden that we're having, risk mitigation. So that if one asset class crashes or doesn't perform well, others will perform well and serve you. Reason number two, goal alignment. You might have different goals. You might have, when investing, you might have short term goals, medium term goals, and long term goals. So, for these goals, you have got different uh, needs for your money. It can be vacation, it can be an emergency fund, it can be uh, pay, school fees payment, doing a project, buying an asset. Each of these goals require different investment types. That's why we invest. Reason number three, compound growth or compounding. When you mix well with the right mix, you get a growth plus income plus stability. Then reason number four, the last one, is peace of mind. When you put your eggs in different baskets, you know exactly what you own and why. So instead of having random investment, so it will give you a peace of mind so that in case one asset is not performing well, you still taken care of by other assets that are potentially doing well. Let's look at 5 steps. This is a 5 step framework, a 5 step procedure of how to build your first portfolio. Step number one, you're going to assess your finances and build an emergency fund. Sometimes we call it safety net. It's always advisable to start with an emergency fund that covers 3 to 6 months of expenses. This money can either be in cash or in a money market fund. Under step number one, pay off high interest debt. This can be mobile loans, this can be other loans short-term loans that you have. Then number 3, decide how much you can afford to invest, either monthly or lump sum. Step 2, define your investment goals. Are you investing for short term, for medium term, or for long term? Short term, 1 to 3 years, can be something like you are saving for a car or saving for a vacation. Medium term, 3 to 10 years, might be buying a house, buying a home, land, or funding for your education. Then long term, 10 plus years, can be retirement or you want to build a legacy. So define your investment goals, and when you're defining these, set SMART goals: specific, measurable, achievable, realistic, and time bound or time based. Step number 3, choose asset classes and then allocation. This is why you are deciding some money will go in a money market fund, some money will go in a government bills or bonds, some in stocks or equities, some in real estate, some in mutual funds, and some in skills or personal development. Each of these classes has got its own purpose. For example, money market funds for liquidity and safety, government bills and bonds for moderate risk and steady income. Real estate or rates, we use that for capital appreciation and inflation hedging. Mutual or unit funds, we use them for diversification via managed funds. Then skills or personal development is essential to improve your capacity or ability to maintain what you have and multiply it so that you have higher amounts in the later years. So that's step number 3. Choose an asset class. Step number 4, pick real instruments. After we have our categories in step number 3, now we pick real instruments. For example, when you go to money market funds, I've done a video on how to invest in money market funds in Kenya. I'll attach it somewhere up here or in the description. Choose the best performing. For example, there are many Nabo, Gulf Cup, Lofty Coban, Etika. There's so many. Do your thorough research. Treasury bills or bonds, subscribe this through the CBK or any licensed broker. Stocks, use a CDS account or a Kenyan broker to buy shares on NSE. Real estate, you buy directly. You can buy a piece of land, piece of plot, or you can invest via REIT, Real Estate Investment Trust Fund. Mutual funds, stock ETFs, you can use a licensed fund houses or regional ETFs. Then skills development, enroll in courses, look for coaching, look for mentorship programs that will help you scale up. The last step is monitor and adjust. Now that you've invested in different asset classes, monitor. Review your portfolio, not on a daily basis, not on a weekly basis, but either 6 to 12 months to see how it's progressing. If one asset grows too big, say for example stocks balloon, sell some and reinvest that money in the lagging areas. This is known as portfolio rebalancing. Then add more capital over time, invest monthly if possible, then adjust based on life changes. Maybe a job has changed, maybe in case of a marriage, maybe in case of children going to school, and you need to do some readjustment. You can always adjust based on the stage of life and the changes that are happening in life as at that particular time. What are some of the challenges when you are developing a portfolio, when you are building a portfolio? Challenge number 1, market volatility. What does this mean? Sometimes assets will go up, sometimes assets will go down. So this variation is what we refer to as market volatility, and it should not affect you, it should not push you into panic buying or panic selling. Challenge number 2, fees and hidden charges. Be careful with funds that are very expensive in terms of funds management fee. Challenge number 3, illiquidity. you might realize that some real estate or some private investments may lock your funds for 6 months, 1 year, 18 months, 4 years, 5 years. And so this illiquidity might affect you. But remember, you have to factor this one initially before you start investing. Challenge number 4, overconfidence. Do not chase returns blindly. Do not make impulse decision. Do not make rash decision. Decide and invest using data, using analytics, using research that you have done. Challenge number 5, taxes and regulation. Always check that the fund or whatever asset you're investing in is authorized by Capital Markets Authority. It's regulated and governed by Capital Markets Authority. It's compliant with Capital Markets Authority. I did a quick example for 2 people. If you have a lump sum of 200,000, you have want to invest, or if you have 5,000 monthly, you have to invest. How would you invest that money? So for someone who has 200,000 and he wants to build an investment portfolio, you put 20% in a money market fund for safety and liquidity. You put 25% in treasury bills for stable income. You'll put 30% in Nairobi Securities Exchange for growth. You'll put 15% in a mutual fund to diversify, and you'll put 10% in real estate scheme. For someone who has got 5,000 monthly, you don't have a lump sum, but you can be investing a particular amount of money on a monthly basis. This is the breakdown. 1,000 to a money market fund on regular basis, 1,500 NSE, 1,000 government securities, 1,000 mutual funds, 500 invest in yourself. You can attend to virtual classes, or you can find a course or a program that you will put that money in to help you become a better person, so that you can learn how to earn more money or manage more money in the future. As we conclude, building an investment portfolio for any person is not complicated. We complicate it. People complicate it. They give you jargons and terms that you can't understand. You just need to plan well. You need to be disciplined, and you need to be consistent. At the end of the day, investing is a long-term game. So it's something that requires you to be a very good planner, finances. You have to be disciplined and be consistent for a long period of time. Another thing that you have to do, just start small. Don't wait for a lump sum, because sometimes you might not get that lump sum. So start small, but diversify and keep learning over time. Over time, your money will compound. Your risks will be managed, and your goals will be closer than you think. So that is it. It's a short video. That's how you build an investment portfolio, and I hope you've gotten some value. Thank you for watching, and I'll see you in the next video. But bye bye for now. Be safe.